Unit 12, Property Management. Learning Objectives. When you have completed this unit, you will be able to accomplish the following. Explain the need for property management as an industry specialization, and the rules regarding the requirement for licensure for property managers. Describe the functions of property managers. Identify the basic elements of a property management agreement. Identify the duties of property managers, including the development of a budget. Explain how property managers can minimize risk. Calculate property management fees and rental commissions. Key terms: after-tax cash flow, appreciation, before-tax cash flow, budget comparison statement, cash flow, cash throw-off, deferred maintenance, effective gross income, equity buildup, leverage, net operating income, operating expenses, potential gross income, profit and loss statement, property management agreement, property manager, rental schedule, vacancy and collection losses. Learning objective. Explain the need for property management as an industry specialization, and the rules regarding the requirement for licensure for property managers. Property management. The need for specialized property managers became apparent during the 1930s, as lending institutions took possession of numerous foreclosed income properties. Lacking the expertise to administer these properties, they looked to the real estate industry for expert management assistance. In recent years, the increased size of buildings, the technical complexities of construction, maintenance, and repair, and the trend toward absentee ownership by individual investors and investment groups have led to the expanded use of professional property managers for both residential and commercial properties. Property management has become so important that many brokerage firms maintain separate management departments staffed by carefully selected, well-trained people. A number of corporate and institutional owners of real estate have also established property management departments. Despite this trend, some real estate investors still manage their own property, and therefore must acquire the knowledge and skills of a property manager. Although property owners have always had the privilege of managing their own property without the need of licensure, they cannot compensate any unlicensed friend, relative, or neighbor for assistance in the management. This includes showing the units and collecting rents. In North Carolina, a brokerage firm or sole proprietorship hired by the landlord owner to act as a property manager must have an active non-provisional real estate broker's license. A property manager who is the employee of the owner is still required to have a real estate license. However, if the owner of the property is a Chapter C or Subchapter S corporation, and the property is titled in the corporation's name, then a W-2 employee without a real estate license will be allowed to manage the property. Only title-holding owners can manage their own property without active North Carolina real estate licenses. The property manager broker can utilize the services of other brokers or unlicensed salaried employees with limited authority. On-site leasing agents who show available units and collect rent payments are frequently unlicensed employees of the property manager. GS 93A2, quoted below, grants licensing exemptions if the employee does not negotiate any lease terms. Any salaried person employed by a licensed real estate broker for and on behalf of the owner of any real estate or the improvements thereon, which the licensed broker has contracted to manage for the owner, if the salaried employee is limited in his employment to exhibiting units on the real estate to prospective tenants, providing the prospective tenants with information about the lease of the units, accepting applications for lease of the units, completing and executing preprinted form leases, and accepting security deposits and rental payments for the units only when the deposits and rental payments are made payable to the owner or the broker employed by the owner. The salaried employee shall not negotiate the amount of security deposits or rental payments and shall not negotiate leases or any rental agreements on behalf of the owner or broker. With the huge increase in the number of homeowner and property owner associations in recent years, there has been a commensurate increase in the demand for association management services. Although licensed property management firms manage some communities, there is currently no real estate license requirement in North Carolina to provide association management. Of course, if brokers are involved in association management, they will be held to the higher level of conduct than an unlicensed manager and subject to license law. In North Carolina, a brokerage firm hired by a landlord owner to act as a property manager must have an active non-provisional broker's license. True, a salaried person employed by a broker to assist with property management can show units to prospective tenants, provide information about the units, accept applications and security deposits, and rental payments made payable to the owner of the broker. True, learning objective. Describe the functions of property managers. Functions of the property manager. In the simplest terms, a property manager is someone who preserves the value of an investment property while generating income. As an agent for the owner, the agency relationship is created by the property management contract. The fiduciary relationship that exists between the property manager and the property owner is based on the same relationship of trust that exists between a real estate broker and a seller or buyer. A property manager usually serves the property owner as a general agent. The property manager is expected to market the property and control operating expenses in order to maximize income. With this expectation in mind, the property manager chooses the best possible means to carry out an agent's responsibilities and has more authority and discretion than an employee. The manager should maintain and modernize the property to preserve and enhance the owner's capital investment. The manager carries out these objectives by securing suitable tenants, collecting the rents, caring for the premises, budgeting and controlling expenses, hiring and supervising employees, keeping proper accounts, and making periodic reports to the owner. Property managers do not perform functions such as making capital improvements, reinvesting profits, paying the owner's income tax, or establishing a depreciation schedule. Securing management business. In today's market, property managers may look to corporate owners, apartment and condominium associations, homeowners associations, investment syndicates, trusts, and absentee owners as possible sources of management business. In securing business from any of these sources, word of mouth is often the best advertising. A manager who consistently demonstrates the ability to increase property income over previous levels should have no difficulty finding new business. Property managers perform such functions as making capital improvements and reinvesting the landlord's profits. False. A property manager usually serves as a specific agent for a landlord. False. Learning objective. Identify the basic elements of a property management agreement. The property management agreement. The first step in taking over the management of any property is to enter into a property management agreement with the owner. This agreement creates an agency relationship between the owner and the property manager. A property manager is usually considered to be a general agent, whereas a residential real estate broker is usually considered to be a special agent. As an agent, the property manager is charged with the same agency responsibilities as the listing broker, the duties of obedience, loyalty, disclosure of information, obedience, confidentiality, accounting, disclosure of information, and reasonable skill, care, and diligence. Duties of broker to third persons include honesty, fairness, disclosure of material fact, and presenting offers. Per Commission Rule A 104, all property management agreements must be in writing from its inception. The property management agreement establishes the authority of the property manager. Unlike other agency agreements, the Commission Rule allows property management agreements to contain an automatic renewal clause if the property owner can terminate with notice at the end of any contract period. Review the North Carolina Association of Realtors exclusive property management agreement to see where the following provisions can be found. Description of the property. Contract period. This period should have definite beginning and ending dates but can allow for automatic term renewal if parties have the opportunity to terminate the agreement at the end of any term period. Management fee. The fee can be based on a percentage of gross income or net operating income, a commission on new rentals, a fixed fee, or a combination of these. For example, the manager may get 3% of all monthly rentals collected. Both the owner and manager must ensure that the agreement is very specific as to how the management fee will be determined. If the manager will collect additional fees, such as application fees or late payment fees, the ownership of those monies must be clarified in the agreement. Definition of management's responsibilities. All of the manager's duties should be stated in the contract. Exceptions should be noted. Important inclusions are to whom the rent and security deposit are paid, the method used in returning security deposits, and the method of paying mortgages, utility costs, and other bills. Adherence to all fair housing laws required. Extent of the manager's authority as an agent. This provision should state what authority the manager is to have in such matters as hiring, firing, and supervising employees, establishing rental rates, making expenditures, and authorizing repairs within the limits set previously with the owner. Authorization for marketing and/or cooperating with or compensating other brokers also would be necessary. Making capital improvements would be the owner's responsibility. Reporting. Agreement should be reached on the frequency and detail of the manager's periodic reports on operations and financial position. These reports enable the owner to monitor the manager's work and serve as a basis for both the owner and the manager to assess trends that can be used in shaping future management policy. Responsibilities of owner. This provision should clarify the duties that the property owner retains, including proper insurance coverage, adherence to fair housing laws, adequate provision of funds for management and maintenance of the property, allocation of the property management expenses, such as fees for custodial help, advertising, supplies, and repairs, should state which are to be charged to the property's expenses versus which are to be paid by the owner. Duties upon termination. Both parties agree to act promptly to settle financial and record-keeping accounts, some of which might include the transfer of funds and notifications of tenants. Miscellaneous provisions. Additional provisions should address tenant security deposits and trust account management, entry of the leased unit by owner or agent during the lease period, and Lead-Based Paint Hazard Reduction Act disclosure compliance. Agent should receive notification of sale of property, and owner should receive notification if the agent assigns or sells ownership right in the property management firm. Owner needs to acknowledge that the manager is a real estate professional, but other service experts might be indicated. After entering into an agreement with a property owner, a manager handles the property as the owner would. In all activities, the manager's first responsibility is to realize the highest return on the property that is consistent with the owner's instructions. Before contracting to manage any property, the professional property manager should be certain that the owner has realistic income expectations and is willing to spend money on necessary maintenance. Attempting to meet impossible owner demands by dubious methods can endanger the manager's reputation and make it difficult to obtain future business. Property management agreements may contain an automatic renewal clause if the property manager can terminate with notice at the end of any contract period. True, the North Carolina Real Estate Commission allows brokers to have an oral property management agreement for up to a 1-year term. False. Learning objective. Identify the duties of property managers, including the development of a budget. Typical property management duties. A property manager must live up to both the letter and the spirit of the property management agreement. The owner must be kept well informed on all matters of policy, as well as on the financial condition of the property and its operation. A manager must stay in contact with others in the field, therefore becoming increasingly knowledgeable and keeping informed on current policies pertaining to the profession. Preparing a management plan. Property management begins with a management plan prepared by the property manager. A management plan outlines the details of the owner's objectives with the property, as well as what the property manager expects to accomplish, and how, including all financial objectives. In preparing a management plan, a property manager should take into consideration 3 factors: the owner's objectives, the regional and neighborhood market analysis, and the specific property analysis. A regional market analysis should include the general economic trend, population trends, employment data, and transportation resources. The neighborhood market analysis should explore many of the same things on a more localized level that include neighborhood amenities and resources. Occupancy, absorption rates, and new starts are critical indicators. The property analysis should evaluate the number and size of the rental units, the physical condition of the property, the occupancy and rental history, plus what makes the property desirable to prospective tenants. The plan also includes a budgetary section on sources of revenue and anticipated expenses. While the management plan is a document for the present, it is forward-looking in determining the feasibility of a property owner's long-term goals for a specific property. One of the primary responsibilities of a property manager is maintaining financial reports, including an operating budget, cash flow report, profit and loss statement, and budget comparison statement. While there are no standard formats for these reports, there is some similarity among the reports, and it is important for the property manager to adapt a report to meet an owner's needs. Operating budget. An operating budget is the projection of income and expense for the operation of a property over a one-year period. This budget, developed before attempting to rent property, is based on anticipated revenues and expenses and provides the owner the amount of anticipated profit. The property uses the operating budget as a guide for the property's financial performance in the present and future. After time, a property manager can develop an operating budget based on the results of the profit and loss statement in comparison to the original budget. After making the comparison, a new operating budget is prepared for a new time period in the future. The manager should also establish a cash reserve fund for variable expenses such as repairs, decorating, and supplies. The amount allocated for the reserve fund can be estimated from previous yearly totals of variable expenses. Capital expenditures. If an owner and a property manager decide that modernization or renovation would enhance the property's value, the manager should budget money to cover the costs of remodeling. The property manager should be thoroughly familiar with the principle of contribution or should seek expert advice when estimating any increase in value expected by an improvement. In the case of large-scale construction, the expenses charged against the property's income should be spread over several years. The property owner decides to make capital improvements based on projections and advice from the property manager. Cash flow report. A cash flow report is a monthly statement that details the financial status of the property. Sources of income and expenses are noted, as well as net operating income and net cash flow. The cash flow report is the most important financial report because it provides a picture of the current financial status of a property. Income. Potential gross income includes potential gross rentals if 100% occupied and collected, delinquent rental payments, utilities, vending, contracts, late fees, and storage charges. Any losses from vacancy and collection losses or bad debt expenses are deducted from the total potential gross income to arrive at the effective gross income. In some properties, there is space that is not income producing, such as the property manager's office. The rental value of the property that is not producing income is subtracted from the gross rental income to equal the gross collectible or billable rental income. Expenses. Fixed and variable expenses include administrative costs, operating expenses, and maintenance costs. Fixed expenses that remain constant and do not change include employee wages and other basic operating costs. Variable expenses may be recurring or non-recurring and can include items such as building repairs and landscaping. The formula for arriving at cash flow is as follows. Potential gross rental income plus other income losses incurred equals effective gross income. Effective gross income operating expenses equals net operating income before debt service. Net operating income before debt service capital expenditures reserves equals cash flow. A profit and loss statement is a financial picture of the revenues and expenses used to determine whether the business has made money or suffered a loss. It may be prepared monthly, quarterly, semi-annually, or annually. The statement is created from the monthly cash flow reports and does not include itemized information. A formula for profit and loss statement looks like this. Gross receipts operating expenses total mortgage payment plus mortgage loan principal equals net profit. Budget comparison statement. The budget comparison statement compares the actual results with the original budget, often giving either percentages or a numerical variance of actual versus projected income and expenses. Budget comparisons are especially helpful in identifying trends in order to help with future budget planning. Investment characteristics. Real estate brokers should have a basic understanding of real estate investment terms and concepts. Whether consumers are investing in their own homes or in non-owner occupied properties, they want assurance that their purchases are going to provide an acceptable return on investment. While brokers should never provide tax or legal advice, they should be able to provide a basic analysis of a property's income and value potential to interested consumers. A person who wishes to buy and personally manage real estate may find property that generates income can be a solid investment. There are several types of income that can be generated by an investment, but generally, the objective of directing funds into income property is to generate spendable income, called cash flow or cash throw-off. Cash flow is the total amount of money remaining after all expenditures have been paid. These expenses generally include taxes, operating costs, and maintenance. Investment analysis can also take into account mortgage payments and income taxes in the calculation of cash flow. Cash flow can also be described as before-tax cash flow and after-tax cash flow. Before-tax cash flow is the amount of money remaining after all expenditures have been paid except for income tax due. After-tax cash flow is the amount of cash remaining after the owner has reported all income from the property, less appropriate tax deductions and any taxes due. Generally, the amount of rent that a property may command depends on a number of factors, including the property's location, physical appearance, and amenities. If the cash flow from rents is not enough to cover all expenses, negative cash flow will result. Negative cash flow is not unusual in the early years of owning an investment property, but a prolonged period of negative cash flow could make it a questionable investment. Landlord investors must also balance the need to receive high rents with the desire to keep operating expenses low. An unhealthy balance of the two could turn an investment into dilapidated property. Investors should anticipate that operating expenses will include regular building maintenance, repairs, utilities, and tenant services. Leverage is the use of borrowed money to finance an investment. An investor often stands to make more money by investing with borrowed money, usually obtained through a mortgage loan or deed of trust loan. Low mortgage payments spread over a long period result in a higher cash flow because they allow the investor to retain more income. In turn, high mortgage payments contribute to a lower cash flow. As a rule, an investor can receive a maximum return from the initial investment by making a small down payment, paying a low interest rate, and spreading mortgage payments over as long a period as possible. The effect of leveraging is to provide a return that reflects the result of market forces on the entire original purchase price, but that is measured only against the actual cash invested. Equity buildup is a result of a loan payment directed toward the principal rather than the interest, plus any gain in property value due to appreciation or increasing value. Two main factors affect appreciation: inflation and intrinsic value. Inflation is the increase in the amount of money in circulation. When more money is available, its value declines. When the value of money declines, wholesale and retail prices rise. An intrinsic value of real estate is the result of a person's individual choices and preferences for a given geographic area. For example, property located in a desirable neighborhood near attractive businesses and shopping areas has a greater intrinsic value to most people than similar property in a more isolated location. As a rule, the greater the intrinsic value, the more money a property commands on its sale. Equity can also increase due to capital improvements to the property as well as paying down of mortgage debt. In a sense, equity buildup is like money in the investor's bank account. Renting the property. The role of the property manager should not be confused with that of a broker acting as a leasing agent. The property manager may use the services of a leasing agent, but that agent does not undertake the full responsibility of maintaining and managing the property. The manager must be concerned with the long-term financial health of the property. The leasing broker is concerned solely with renting space. Note that in North Carolina, renting residential properties and dealing with residential tenants, property managers must be sure to follow the requirements of the North Carolina Residential Rental Agreements Act and Tenant Security Deposit Act. Establishing a rental schedule. In establishing a rental schedule for a property, a manager must be concerned that, in the long term, the income from the rentable space will cover the property's fixed charges and operating expenses, plus provide a fair return on the investment. Consideration must be given to the prevailing rates in comparable buildings and the current level of vacancy in the property to be rented, supply and demand. Once the manager makes a detailed survey of the competitive space available in the neighborhood, rental prices should be adjusted for differences between these neighboring properties and the subject property. Annual rent adjustments are usually warranted. Note that although residential apartment rental rates are stated in monthly amounts per unit, office and commercial space rentals may be stated according to the annual or the monthly rate per square foot of space. In establishing rental rates, the property manager has 4 long-term considerations. The rental income must be sufficient to cover the property's fixed charges, such as taxes and insurance, and operating expenses, such as maintenance. The rental income must provide a fair return on the owner's investment. The rental rate should be in line with prevailing rates in comparable properties. It may be slightly higher or slightly lower, depending on the strength of the property. The current vacancy rate in the property is a good indicator of how large a rent increase is advisable. A building with a low vacancy rate is a better candidate for an increase than one with a high vacancy rate. If a high level of vacancy exists, an immediate effort should be made to determine why. A high level of vacancy does not necessarily indicate that rents are too high. The trouble may be inept management or defects in the property. The manager first should attempt to identify the problem and correct it, rather than automatically lowering rents. Conversely, even though a high percentage of occupancy may appear to indicate an effective rental program, it could also mean that rental rates are too low. With an apartment or office building, anytime the occupancy level exceeds 95%, an analysis should be made to be certain that the building rates are not below market. Marketing the property. One of the property manager's duties is to market the property to potential suitable tenants. The property management agreement generally authorizes the placement of signs on the property in compliance with any zoning or restrictive covenants. Advertising on the internet as well as print media also will expose the property to the general public. It should be noted that any advertising or marketing activities must comply with all federal, state, and local fair housing laws. A cost-benefit analysis helps a property manager assess whether a particular advertising method worked to attract new tenants. Property marketing expenses are usually figured on a cost per prospect per lease basis. For example, if a 3-bedroom apartment rents for $1,500, and is typically viewed by 10 prospects before it is leased, an $800 newspaper advertisement would cost $80 per prospect. Selecting tenants. Generally, the highest rents can be secured from satisfied tenants. A residential broker dealing only with sales may sell a property, and that have no further dealings with the purchaser, but much of a property manager broker's success depends on retaining sound, long-term relationships. The first and most important step is selection. In selecting a prospective commercial or industrial tenant, a manager should be certain that the size of the space meets the tenant's requirements. The tenant has the ability to pay for the space. The tenant's business is compatible with the building and the other tenants' businesses. And if the tenant is likely to expand in the future, expansion space will be available. Once a prospect becomes a tenant, the manager must be certain that the tenant remains satisfied in all respects commensurate with fair business dealings. Note that in selecting residential tenants, the property manager must comply with all federal, state, and local fair housing laws. Lease application requirements and rental policies that are uniformly applied to all lease applicants are not discriminatory in nature and constitute good business practices. Requiring all applicants to pay an application fee that will purchase a criminal records background check and a credit report can reduce the likelihood of renting to an unqualified tenant. A property manager's desire for a high level of occupancy should not override good judgment in accepting only those tenants who can be expected to meet their financial obligations to the property owner. The property manager should uniformly investigate financial references given by the prospect, by local credit bureaus, and, when possible, by the prospective tenant's former landlords. Collecting rents. The best way to minimize problems with rent collection is to make certain that the property manager has qualified all prospective tenants in the first place. The terms of rental payment should be spelled out in detail in the lease agreement. The property manager should establish a consistent, enforced collection plan with a sufficient system of notices and records. In cases of delinquency, every attempt must be made to make collections without resorting to legal action. For those cases in which legal recourse is required, the property manager must be prepared to promptly initiate and follow through in conjunction with legal counsel. It is important that property managers scrupulously follow all state laws, rules, and regulations when it comes to collecting and accounting for rents. The North Carolina Real Estate License Law and NCREC's rules require that property managers deposit funds into trust accounts by mandated deadlines and maintain detailed and accurate trust account records. The Tenant Security Deposit Act limits the amount of security deposits for residential property that can be required and mandates how they must be handled. The property manager can collect tenant security deposits only if authorized in the property management agreement, performing landlord's duties under the lease. The property manager broker is considered by many leases to be the landlord as pertains to conducting actions or providing services to the tenants. The establishment and implementation of rules and regulations dealing with a multitude of issues within multi-tenant properties will help ensure satisfied tenants and landlords. A manager would be expected to coordinate and provide negotiated tenant services on behalf of the landlord, such as janitorial services, required repairs, and grounds maintenance. Instituting legal actions, such as eviction proceedings, would also fall to the capable hands of the property manager. Accountability and record keeping. It is crucial that property managers maintain accurate records of all monies received and handled on behalf of the landlord. Records of leases in compliance with various laws, such as the Lead-Based Paint Hazard Reduction Act, must also be maintained for a minimum of 3 years from the date of last activity. Unless otherwise negotiated in the property management agreement, the manager should render monthly accounting to the landlord. The property manager broker will be held responsible for compliance with all trust account maintenance laws even if daily trust fund activities were delegated to another person, such as a bookkeeper. Maintaining the property. One of the most important functions of a property manager is the supervision of property maintenance. A manager must learn to balance the services provided with the costs they entail in order to satisfy the tenant's needs while minimizing operating expenses. Assuring that tenants are being charged for repairs needed to correct damage occurring during tenancy helps minimize out-of-pocket expense for the property owner. Completion of a property condition checklist prior to possession by a new tenant can be compared to a newly completed checklist immediately before tenant is due to vacate the premises. This will aid in the proper and accurate damage assessment in the leased property. Efficient property maintenance demands accurate assessment of the needs of the building and the number and kinds of personnel that will meet these needs. Because staffing and scheduling requirements will vary with the type, size, and regional location of the property, the owner and the manager usually agree in advance on maintenance objectives for the property. For one property, the most viable plan may be to operate with a low occupancy level and minimal expenditures for services and maintenance. Another property may be more lucrative if kept in top condition and operated with all possible tenant services, because it can then command premium rental rates. The manager first must protect the physical integrity of the property to ensure that the condition of the building and its grounds is kept at present levels over the long term. For example, preserving the property by repainting the exterior or replacing the heating system will help keep the building functional and decrease routine maintenance costs. Property maintenance encompasses 4 areas: preventive maintenance, repair or corrective maintenance, routine maintenance and cleaning, and construction. Preventive maintenance includes regularly scheduled activities, such as regular painting and periodic lubrication of gears and motors, that will maintain the structure so that the long-range value and physical integrity of the building are preserved. Most authorities agree that preventive upkeep is the most critical, but most neglected maintenance responsibility. Repair or corrective maintenance involves the actual repairs that keep the building's equipment, utilities, and amenities functioning as contracted for by the tenants. Repairing a boiler, fixing a leaky faucet, and mending a broken air conditioning unit are acts of repair maintenance. The property manager must also supervise routine maintenance and cleaning throughout the building, including such day-to-day duties as cleaning common areas, performing minor carpentry and plumbing tasks, and providing regularly scheduled upkeep of heating, air conditioning, and landscaping. Deferred maintenance can cause a rental property to diminish in value. When property managers and owners postpone taking care of their properties by failing to take care of routine matters, such as landscape upkeep or checking on air conditioning systems, or by ignoring necessary repairs, prospective tenants will notice such neglect and choose other possible rentals. Moreover, deferred maintenance can lead to harm to tenants or their personal property. Finally, property maintenance requires new or renovative construction. Especially when handling commercial or industrial space, the property manager often is called on to make tenant improvements, alterations to the interior of the building to meet the functional demands of the tenants. These alterations may range from repainting to completely gutting the interior and redefining the space. Tenant improvements are especially important when renting new buildings because the interior is usually left as an unfinished shell so that it can be customized for individual tenants. Supervision of modernization or renovation of buildings that have become functionally obsolete and unsuited to today's building needs is also important. The renovation of a building often increases the building's marketability and therefore its income potential. Hiring employees versus contracting for services. One of the major decisions a property manager faces is whether to contract for maintenance services from an outside firm or to hire on-site employees to perform such tasks. This decision should be based on a number of factors, including size of the building and land area, complexity of tenants' requirements, and availability of suitable, affordable labor. Handling environmental concerns. With the proliferation of federal and state laws and the increase in local regulation, environmental concerns have become a major responsibility of the property manager and will require increased management time and attention in the future. Although property managers are not expected to be experts in all of the disciplines necessary to operate a modern building, they are expected to be knowledgeable in many diverse subjects, most of which are technical in nature. The property manager must be able to respond to a variety of environmental problems. She may manage structures containing asbestos, mold, or radon, or be asked to arrange an environmental audit of a property. Note that lead-based paint disclosures are required for residential tenant-occupied property built prior to 1978. The manager must see that hazardous wastes produced by her employer or a building's tenants receive proper disposal. Even the normally non-hazardous waste of an office building must be controlled to avoid violation of laws requiring segregation of types of wastes. In areas where recycling is practiced, the property manager must provide the facilities and see that tenants sort their trash properly. The Americans with Disabilities Act. The Americans with Disabilities Act has had a significant impact on the responsibilities of the property manager, both in building amenities and in employment issues. Title I of the ADA provides for the employment of qualified job applicants regardless of their disability. Any employer with 15 or more employees must adopt non-discriminatory employment procedures. In addition, employers must make reasonable accommodations to enable individuals with disabilities to perform essential job functions. Property managers must also be familiar with Title III of the ADA, which prohibits discrimination in commercial properties and public accommodations. The ADA requires that managers ensure that people with disabilities have full and equal access to facilities and services. The property manager typically is responsible for determining whether a building meets the ADA's accessibility requirements. The property manager must also prepare a plan for retrofitting a building that is not in compliance when removal of existing barriers is readily achievable, that is, can be performed without much difficulty or expense. There are some tax advantages available to help offset the expense of complying with ADA requirements. ADA experts may be consulted, as may architectural designers who specialize in accessibility issues. To protect owners of existing structures from the massive expense of extensive remodeling, the ADA recommends reasonably achievable accommodations to provide access to the facilities and services. New construction and remodeling, however, must meet higher standards of accessibility and usability because it costs less to incorporate accessible features in the design than to retrofit. Though the law intends to provide for people with disabilities, many of the accessible design features and accommodations benefit everyone. In practice, the U.S. Department of Justice has ADA specialists available to answer general information questions about compliance issues. The ADA information line is at 800-514-0301. The ADA website is http://www.ada.gov/. Existing barriers must be removed when this can be accomplished in a readily achievable manner, that is, with little difficulty and at low cost. The following are typical examples of readily achievable modifications: ramping or removing an obstacle from an otherwise accessible entrance, lowering wall-mounted public telephones, adding raised letters and braille markings on elevator buttons, installing auditory signals in elevators, reversing the direction in which doors open. Alternative methods can be used to provide reasonable accommodations if extensive restructuring is impractical, or if retrofitting is unduly expensive. For instance, installing a cup dispenser at a water fountain that is too high for an individual in a wheelchair may be more practical than installing a lower unit. In practice, federal, state, and local laws may provide additional requirements for accommodating people with disabilities. Brokers should be aware of the full range of laws to ensure that their practices are in compliance. Watch the video to learn more about the provisions of the Americans with Disabilities Act that impact property management. Cash flow is the use of borrowed money to finance an investment. False. Effective gross income refers to the monies that would be collected if 100% of the rents had been collected. False. Learning objective. Explain how property managers can minimize risk. Risk management for property managers. Homeowners are not the only ones who should be concerned about property insurance. Because enormous dollar losses can result from certain occurrences, one of the most critical areas of responsibility for a property manager is the field of insurance. Knowing the purposes of insurance coverage and how to make best use of the many types of insurance available is part of risk management. Risk management involves answering the question, what will happen if something goes wrong? The perils of any risk must be evaluated in terms of options. In considering the possibility of a loss, the property manager must decide whether it is better to avoid it by removing the source of risk, such as a swimming pool, retain it to a certain extent by insuring it with a large deductible, control it by installing sprinklers, fire doors, and other preventive measures, or transfer it by taking out an insurance policy. When insurance is considered, a competent, reliable insurance agent should be selected to survey the property and make recommendations. Additional insurance surveys should be obtained if any questions remain. Final decisions, however, must be made by the property owner. A proper decision as to how much and what type of insurance to purchase and where to focus the insurance could save many thousands of dollars, especially in large buildings. The addition of lease requirements could contribute to risk management. Requiring tenants to purchase renters' insurance as a condition of the lease is possibly a way to minimize risk. Also, by refusing to allow certain types or breeds as pets, such as pit bull or Doberman dogs, the insurance premiums may be lowered due to the reduction in liability. Property managers often are responsible for large sums of funds held in escrow for owners and tenants. Often these funds are administered by the managers or their bookkeepers. Bonding should be seriously considered for employees who have such financial responsibilities. Bonding provides a form of honesty insurance so that any money lost or embezzled by an employee will be reimbursed by the insurance company. Types of insurance coverage. Many kinds of insurance coverage are available to income property owners and managers. The following are some of the more common types. Fire and hazard. Fire insurance policies provide coverage against direct loss or damage to property from a fire on the premises. Standard fire coverage can be extended to cover hazards such as windstorm, hail, smoke damage, or civil insurrection. Consequential loss, use, and occupancy. Consequential loss insurance, which can include rent loss, covers the loss of revenue to a business if the business's property cannot be used. Contents and personal property. This type of insurance covers building contents and personal property during periods when neither is actually located on the business premises, such as stolen from the company van while traveling. Liability. Public liability insurance covers the risks an owner assumes when the public enters the building. Payments under this coverage are used to settle claims for medical expenses for a person injured in the building as a result of the owner's negligence. Another liability risk is that of medical or hospital payments for injuries sustained by building employees in the course of their employment. These claims are covered by state laws known as Workers' Compensation Acts. These laws require that a building owner who is an employer obtain a workers' compensation policy from a private insurance company. Casualty insurance policies include coverage against theft, burglary, vandalism, and machinery damage, as well as health and accident insurance. Casualty policies are usually written on specific risks, such as theft, rather than being all-inclusive. Surety bonds. Surety bonds cover an owner against financial losses resulting from an employee's criminal acts or negligence while performing assigned duties. Today, many insurance companies offer multi-peril policies for apartment and business buildings. These policies offer the property manager an insurance package that includes such standard types of commercial coverage as fire, hazard, public liability, and casualty. Claims. When a claim is made under a policy insuring a building or another physical object, the amount of the claim can be determined using one of two methods: the depreciated actual value or cash value of the damaged property, or the current replacement cost. When purchasing insurance, a manager must assess whether the property should be insured at full replacement cost or at depreciated cost. As with the homeowner's policies discussed earlier, commercial policies include coinsurance clauses that require that the insured carry fire coverage, usually in an amount equal to 80% of the building's replacement value. In practice, brokers must be sure that homebuyers acquire a homeowner's insurance policy on or before the day of closing. This is required if there will be a mortgage, but it is still strongly advised if it is a cash purchase. Buyers should be reminded that the typical homeowner's insurance policies do not provide coverage for termite damage, breakdown of appliances, flood damage, loss of trees, or losses incurred over an extended period of time. Assuming the seller's policy could mean that the buyer does not have a policy that fits the buyer's needs. One way for a property manager to control risk is by advising the landlord to purchase appropriate insurance policies. True, property management risk can be controlled by installing safety measures such as fire doors, smoke alarms, and refusing to rent to tenants with certain types of pets. True, learning objective. Calculate property management fees and rental commissions. Math concepts. Property management fee. As mentioned earlier, the property management fee can be based on a percentage of gross or net income, a commission on new rentals, a fixed fee, or a combination of these. Example: assume a property management agreement provides that the property manager gets 9% of all rents collected from a 10-unit apartment building. 2 of the units are studio apartments that each rent for $250 a month. 6 of the units are one-bedroom apartments that each rent for $325 a month. The remaining 2 units are 2-bedroom apartments that each rent for $400 a month. Because of vacancies and collection losses, the property manager collects the rent for both studio apartments but for only 5 of the one-bedroom apartments and only 1 of the 2-bedroom units. The property manager's fee is calculated as follows: $250 times 2 units equals $500. $325 times 5 units equals $1,625. $400 times 1 unit equals $400. $2,525. Total rents collected times 0.09% of rents collected equals $227.25 manager's fee for this month. As with real estate sales commission rates, all management fees must be negotiable between the parties. It is a violation of federal antitrust laws for property managers to conspire to set standard rates for their local areas. It is recommended that brokers should have a clear understanding with the owner of all the services to be rendered, and who will pay for particular advertising and operating expenses prior to negotiating a property management fee. Rental commissions. Rental commissions are usually based on the annual rent from a property. For example, if an office unit rents for $475 per month, and the commission rate is 8%. The commission is calculated as follows. $475 per month times 12 months equals $5,700. $5,700 times 0.08 equals $456 annual commission. Commissions are usually based on the monthly rent from a property. False. If the commission rate is 10% and an office rents for $1,000 per month, the commission would be $1,000. False. Key point review. A property manager, whether an individual or a company, acts as the general agent of the investment property owner and has fiduciary duties to the owner of loyalty, obedience, accounting, disclosure, and care in administering the property to accomplish the following: achieve the objectives of the owner, generate income for the owner, preserve and increase the property's value. In North Carolina, a property manager must be a non-provisional broker who can employ other brokers or unlicensed persons for activities that do not require a license. A leasing agent does not have to be licensed as long as they do not negotiate any lease terms. A property manager for corporate-owned properties is usually an unlicensed employee of the corporation. A property management agreement should include the following: description of the property, time period of the agreement, method of termination of the agreement, definition of the management's responsibilities, including limitations and restrictions, statement of the owner's purpose, long-term goals, owner's responsibilities for management expenses, extent of the manager's authority, reporting requirements of the owner and the state, compensation to the manager, compliance with applicable federal, state, and local laws, financial reports, periodic profit and loss statement providing general financial information, budget comparison statement comparing actual results with original budget. The objective of directing funds into income property is to generate spendable income, called cash flow or cash throw-off. Cash flow is the total amount of money remaining after all expenditures have been paid. These expenses generally include taxes, operating costs, and maintenance. Before tax cash flow is the amount of money remaining after all expenditures have been paid except for income tax due. After tax cash flow is the amount of cash remaining after the owner has reported all income from the property less appropriate tax deductions and any taxes due. Risk is directly proportional to degree of leverage or the use of borrowed funds. Equity buildup takes place with the reduction of mortgage debt and with property appreciation. Typical property manager duties include the following: preparing a management plan, preparing an operating budget, renting the property, establishing a rental schedule, marketing the property, tenant selection within certain parameters while complying with all applicable federal, state, and local fair housing, anti-discrimination, and equal opportunity laws, collecting rent, performing the landlord's duties, accounting and record-keeping, maintaining the property, handling environmental concerns. Property managers are affected by Americans with Disabilities Act, which includes the following. Title I applies to employers with 15 or more employees and provides for employment of qualified job applicants, regardless of disability, with reasonable accommodations. Title III prohibits discrimination in commercial properties and public accommodations and requires that access to facilities and services be provided when reasonably achievable in existing buildings, with a higher standard for new construction or remodeling. Risk management includes treatment of risk by deciding whether to avoid it, control it, transfer it, or retain it, and focuses on tenant security and types of insurance available.